The other instance, which is probably the more frequent one, it is our issuer who will tell us or ask us if we could do an extra 2, 5, 6 million a few hours before closing. And therefore, we have not allocated either client X coming from the accountant reducing their participation, or this new allocation that we're receiving from that we accept to get from the issuer. So in both cases, we end up with unallocated flow-through shares. So what we do with them is PearTree has created about 12 years ago a limited partnership. It is called the Mineral Exploration Investment, MEI, the acronym MEI Limited Partnership, LP. And we will, let's call it 5. There is $5 million extra. So we PearTree will buy, the limited partnership will buy the 5 million. We will be selling it on April 3rd, just like all the other participants. And we will, in fact, be crystallizing $5 million of Canadian exploration expenses and investment tax credit. All right. So, but PearTree is not out of pocket 5 million. We're out of pocket 2.5 million. So we turn around, because we bought at 5, we sold at 2.5. So we turn around and then we sell units, the 2.5 million, in different increments to individuals who are looking to they have done or not their philanthropy, and they are still very taxable, and therefore they're looking at a way to reduce their tax burden. So they can participate for $100 as an example. They will be receiving $200 worth of Canadian exploration expenses, which they can take against their own personal income at the end of the year. In this instance, there is no donation attached to it, okay?
Right.
So it's just the Canadian exploration expenses, the CEE, and the investment tax credit that are associated to you participating in a limited partnership. In a perfect world, we started by vision and mission. In a perfect world, our vision is that the 500 million will be used for philanthropic use at the end of the day or at the end of the year. So we have used every single dollar to facilitate a charitable donation from our existing and prospective donors or clients. But we all know that there is always an imbalance for the couple of examples we gave a few seconds ago. So therefore, we have this new product. We only have 2 products, the donation product and the non-donation product. It's relatively simple. And to be honest with you, Eric, I really like saying this because I'm never in competition. PearTree, we're never in competition with the tax specialists, with the financial planners, with the accountants, with the lawyers, with the family offices. We're a complement. We don't do what they do, and they don't do what we do, right? So it's a very nice complement, a new tool in the toolbox for them. And just to repeat myself, we have a team of analysts who we use for you, for our clients, for our prospective clients, independently if you're going to subscribe or participate or not. We just want to make sure that the assessment is done properly, that we are avoiding, coming back to alternate minimum tax. AMT is not a illness. I mean, there is a potential that you may trigger it, and we can talk about it in a few seconds. But generally speaking, I would say 95% of our clients will ask us the question, what is my maximum LP or donation given my revenues and avoiding alternate minimum tax? But we also have in the 5%, Johnny or Susie or John coming to us and say, I was at the board meeting last night. We all made a commitment of a $75,000 donation for the new wing or the new whatever at the hospital or the university. Here's my fact pattern. My income is X, my expenses are Y, et cetera, Can I do a 75? And in one example, the client will be able to do 75, but doesn't have enough taxable income at the highest marginal rate to take to absorb all of the deductions in 2025. What we will recommend to accountants is to take 100% of the charitable donation, to take 100% of the investment tax credit in this specific order, and finally top up with the expenses, the Canadian exploration expenses. In doing, and not touch your alternate minimum tax. In doing so, you are carrying over expenses in 2026 instead of trying to create some space to absorb the taxes that you were not able to take the previous year because of AMT. I'm not sure if I made myself clear, but it's easier to carry an expense than to trigger alternate minimum tax. Let's summarize it that way. And the Canadian exploration expenses can be carried forward forever. Okay, so whereas AMT only has a 7-year shelf life, Canadian exploration expenses can be carried forward forever. So if it's not next year, it's the following year, and
eventually
our donor has done